2,200 tons every single day. That is how much silver trades on the COMEX futures exchange. 1,200 tons per day. 38.5 million ounces changing hands before lunch. Here is the problem: that silver does not exist. It has never existed. It will never exist. It is ghost silver, phantom metal. Numbers in a computer that control the price of real silver sitting in real vaults owned by real people. The entire global silver mining industry produces 820 million ounces per year. The COMEX trades that amount in less than a month. They are trading 12 times more silver than is actually mined. They are trading silver that is still in the ground, silver that has not been discovered yet, silver that might never be found. This is the ghost market. It is the shadow system that controls the price you pay for real metal. It is the mechanism that allows a handful of banks to determine what silver is worth, regardless of actual supply and demand. And for 40 years, it has worked. The ghost market has suppressed silver prices. It has crushed rallies. It has broken investors. It has made physical silver artificially cheap. But every ghost market has a weakness. Every phantom system eventually meets reality. And when Comdau's 200 tons of paper promises collide with a physical market that is draining to zero, the ghosts will be exposed. The fraud will be revealed, and the price will reset to reflect what silver is actually worth. Let me show you exactly how this ghost market operates and why it is about to collapse. Context: 1 dollars to 5. To understand the ghost market, you need to understand how precious metals pricing actually works. Because it does not work the way you think. It does not work the way it should. It works in a way specifically designed to allow infinite paper claims on finite physical metal. There are two silver markets operating simultaneously: the physical market and the paper market. In a rational world, these markets would be the same. The price of paper silver would equal the price of physical silver. But we do not live in a rational world. We live in a world where banks have discovered they can create unlimited paper supply to overwhelm limited physical supply. The physical market is simple. Miners produce silver. Refiners process it into bars. Dealers sell bars and coins to investors and industrial users. Someone mines an ounce. Someone else buys an ounce. The transaction involves actual metal changing hands. Supply and demand determine price. The paper market is completely different. It trades contracts, promises, derivatives, futures agreements that supposedly represent silver but rarely result in physical delivery. The COMEX, which is the primary silver futures exchange, allows traders to buy and sell claims on silver without ever touching metal. Over 95% of contracts are settled in cash. The silver never moves. It does not need to move. It does not need to exist. This creates a problem, or rather, it creates an opportunity for manipulation. If you can sell unlimited paper contracts, you can create unlimited artificial supply. Real supply is constrained by what comes out of the ground. Paper supply is constrained only by the willingness of banks to take the other side of the trade. Here is how the math works. The COMEX daily trading volume in silver futures averages approximately 70,000 contracts. Each contract represents 5,000 ounces. That is 350 million ounces per day. At current prices, that is over $10 billion in notional value traded daily. But COMEX registered silver inventory, the metal actually available for delivery, is approximately 35 million ounces. They are trading 10 times more silver every day than exists in the vaults. The leverage ratio is 10 to 1 on daily trading alone. Zoom out to open interest, the total number of outstanding contracts, and the ratio becomes even more extreme. Open interest often exceeds 140,000 contracts. That is 700 million ounces of paper claims against 35 million ounces of deliverable metal, a leverage ratio of 20 to 1. Some analysts calculate total paper silver exposure, including ETFs, unallocated accounts, and over-the-counter derivatives at over 250 paper ounces for every physical ounce. 250 people think they own the same bar. Only one of them actually does. This is the ghost market. The 249 phantom ounces that do not exist but still affect the price. Let me explain the mechanics of how 1,200 tons of ghost silver controls the price of real silver. Because once you understand the mechanism, you can never unsee it. Every price movement will make sense. Every manipulation will be visible. The ghost market operates through three primary channels. Channel 1. Algorithmic futures dumping. This is the most visible manipulation technique. It has been documented, it has been prosecuted, it resulted in a $920 million fine for JP Morgan, and it continues to this day. Here is how it works. The paper market is controlled by algorithms, high-frequency trading programs that monitor price, volume, and momentum in real time. When silver starts to rise, when physical demand is strong, when the price threatens to break out, the algorithms activate. Within seconds, massive sell orders hit the market. We are talking 5,000 contracts dumped in under a minute, 10,000 contracts in the opening hours of trading, 25 million ounces of paper silver created out of thin air and sold into the market. This creates artificial supply. It overwhelms buying pressure. It triggers stop-loss orders from other traders. It creates a cascade of selling that feeds on itself. The price crashes. Physical demand is unchanged. The fundamentals are unchanged. But the paper manipulation crashes the price anyway. The algorithms specifically target low liquidity periods. Sunday evening when Asian markets are opening. Early morning before New York traders are at their desks. Holiday periods when volume is thin. A small amount of paper selling has maximum impact during these windows. I have seen it happen in real time. Silver will be rising in Asian physical markets. Premiums in Shanghai will be elevated. Demand is clearly strong. Then 6 a.m. Eastern, before COMEX officially opens, a massive sell order hits the Globex electronic market. Thousands of contracts. The price drops $0.50 in minutes. By the time most traders are awake, the damage is done. Channel 2. Spoofing and layering. This technique involves placing fake orders to manipulate perception. Traders place massive sell orders above the current price. These orders are visible to other market participants. They create the appearance of resistance. Other traders see the sell wall and assume the price cannot go higher. They sell or do not buy. Then, before the fake orders can be executed, they are canceled. The spoofer never intended to sell. They just wanted to create the illusion of supply. They wanted to scare other traders. They wanted to cap the price without actually transacting. JP Morgan traders did this thousands of times between 2008 and 2016. It was documented, it was prosecuted. The bank paid $920 million. The individual traders were criminally charged. The spoofing was proven beyond reasonable doubt, but the fine was a cost of doing business. The profits from manipulation far exceeded the penalty, and there is no evidence the practice has stopped. The algorithms have just become more sophisticated. The patterns are harder to detect. The manipulation continues. Channel 3. Unallocated accounts and ETF leasing. This is the most insidious form of ghost silver. It looks legitimate, it feels safe, but it is pure illusion. When you open an unallocated gold or silver account at a major bank, you think you own metal. The statement says you own metal, but you do not own specific bars. You own a claim on the bank's general pool, and that general pool can be leveraged, leased, hypothecated, and used for multiple purposes simultaneously. The same metal that backs your unallocated account might also back 10 other accounts. It might be leased to a short seller. It might be pledged as collateral for a loan. There is no segregation. There is no identification. There is only a promise that if you ask for metal, they will provide it. The same dynamic exists in ETFs. The SLV prospectus explicitly states that the fund may not be able to acquire physical silver during periods of high demand. They can settle in cash. They can halt redemptions. The metal you think you own exists on paper. In reality, it may or may not be there. All of these channels create ghost silver, paper claims that suppress the price without requiring actual metal. The 1,200 tons that trade daily are ghosts. They are phantoms that haunt the market and prevent real price discovery. Let me show you the concrete evidence that the ghost market is manipulating prices, because this is not theory. This is documented fact. Evidence 1. The J.P. Morgan prosecution. In 2020, J.P. Morgan Chase agreed to pay $920 million to resolve criminal charges for manipulating precious metals markets. The Department of Justice documented thousands of instances of spoofing. Traders placed fake orders to move prices, then canceled before execution. The manipulation occurred over 8 years. It involved multiple traders across multiple desks. It was systematic. It was institutional. It was policy. And J.P. Morgan remains the largest trader in silver futures to this day? The behavior was prosecuted. There is no evidence it stopped. Evidence 2. The concentration of short positions. CFTC commitment of traders reports show that 4 or fewer large traders consistently hold short positions equivalent to 50% or more of annual mine production. 4 traders, controlling half the annual supply. This concentration is unique to silver. It does not exist in other commodity markets. It exists because silver is small enough to manipulate and important enough to control. Evidence 3. Price behavior patterns. Academic studies have documented anomalous price behavior in silver markets. Prices systematically decline during the London AM fix. They decline at COMEX opening. They decline during low liquidity periods. These patterns are statistically significant. They cannot be explained by random trading. They can only be explained by coordinated intervention. Evidence 4. Physical premiums divergence. If the paper price were accurate, physical premiums would be minimal, transaction costs plus a small margin. Instead, physical premiums have been running 15% to 25% above spot for 3 years. American Silver Eagles often command $10 to $12 over spot. This premium is the market screaming that the paper price is wrong. Evidence 5. Delivery failures and inventory drain. COMEX registered inventory has declined 70% since 2021, from over 150 million ounces to approximately 35 million ounces. Metal is leaving the vaults. Delivery demands are increasing, yet the paper price has not risen proportionally. The physical market is tightening while the ghost market holds the price down. Evidence 6. Eastern market divergence. Gold and silver routinely trade at premiums in Shanghai, Dubai, and Mumbai compared to Western paper prices. Sometimes the premium is $30 to $50 per ounce for gold. Sometimes silver premiums exceed 10%. These are not transaction costs. These are physical markets rejecting the paper price as inaccurate. The evidence is overwhelming. The ghost market exists. It manipulates prices, and it is documented in court cases, regulatory data, academic studies, and market behavior. Why the ghost market must collapse. 15 hour to 1830. Every ghost market eventually collapses. Every paper scheme eventually meets physical reality. The question is not if the silver ghost market fails. The question is when and how violently. Here is why collapse is inevitable. Reason 1. Physical supply is genuinely constrained. The ghost market works by creating artificial paper supply, but it cannot create physical silver, and physical silver is running out. The silver market has been in deficit for 4 consecutive years. Demand exceeds supply by approximately 200 million ounces annually. That deficit comes from existing stockpiles, from ETF holdings, from COMEX vaults, from private hoards that can be mobilized at the right price. Those stockpiles are finite. They are depleting. Every year there is less cushion between paper promises and physical reality. Eventually, there is no cushion at all. Reason 2. Industrial demand is inelastic. Over 60% of silver demand is industrial. Solar panels, electronics, medical devices, EVs. These users need silver regardless of price. They cannot substitute. They cannot wait. They must have metal. As industrial demand grows, it consumes physical silver that might otherwise be available to settle paper claims. The solar industry alone will require over 200 million ounces annually by 2030. That is metal that cannot back paper promises. That is physical demand that ignores the ghost market entirely. Reason 3. Eastern markets are draining Western vaults. China and India are importing silver at record rates. That metal is leaving London, leaving New York, moving to Shanghai and Mumbai. It is not coming back. The ghost market depends on Western vault inventory to maintain the illusion of deliverability. As that inventory moves east, the illusion weakens. The COMEX claims to have deliverable silver. Each month, there is less. At some point, there is none. Reason 4. The leverage is unsustainable. 250 paper ounces for every physical ounce. That is a leverage ratio that cannot survive a crisis of confidence. If even 1% of paper holders demand physical delivery, the system breaks. Every month, more investors understand this dynamic. More institutional buyers demand allocated, segregated metal. More central banks take physical delivery. The demand for real versus paper is shifting. The leverage must eventually unwind. Reason 5. Trust is eroding. The J.P. Morgan prosecution exposed the manipulation. The COMEX inventory decline is visible to anyone who looks. The premiums tell the story. People no longer believe the paper price reflects reality. Once trust is gone, it cannot be restored. Paper gold and paper silver work only because people accept them as equivalent to physical. When they stop accepting, when they demand real metal, the ghost market dies. Let me explain exactly how the ghost market affects you personally. Because this is not abstract market mechanics. This is about your wealth, your savings, and your purchasing power. First, you are being robbed through price suppression. The ghost market keeps silver prices artificially low. If 200 tons of fake silver were not dumped on the market daily, the real price would be much higher. You could be holding an asset worth $50 per ounce. Instead, manipulation holds it at $31. Your wealth is being suppressed. But this suppression is also an opportunity. You can acquire real silver at artificially low prices. You can exchange paper dollars for physical metal at a discount to true value. The manipulation that robs current holders subsidizes new buyers. Second, your paper silver is worth less than you think. If you own SLV, if you have an unallocated account, if you hold silver futures, you own ghost silver. You own one of the 250 paper claims on each physical ounce. When the collapse comes, you will not receive metal.